Well, good morning, everyone, and welcome to today's BizTech Huìhuà chat. A very good evening to those in China, and a very warm good morning to those of us here in Europe. As many of you will be aware, we at Xi'an and the FS Club have been hosting a series of BizTech Huìhuà chats, really on the idea of keeping communications up and running on advancing topics in technology, economics, and finance between Europe and Asia. We've held a number of such events on a variety of subjects, but today we're going to be looking at developing emissions trading markets. In previous sessions, we've looked at things ranging from healthcare to energy systems, but most recently we had a session on hydrogen trading. And the reason for focusing on hydrogen trading last week and emissions trading schemes this week is, of course, that we're hosting here in London on the 24th of May, the Net Zero Delivery Summit, which is the 6-monthly checkpoint where businesses and investors see how well we're doing against the COP targets in between the various COP sessions. So this one is going to be attended by Egypt, in effect, handing over to Abu Dhabi, United Arab Emirates, where in fact the COP28 will be held this November and December. Anyway, my name is Michael Mainelli. I'm one of the directors of Xi'an, and it really is a privilege to be able to introduce so many of these events, which we can only do so because of the kindness, tolerance, and may I say wide-ranging interests of our sponsors, who allow us to range widely and freely across technology, economics, and finance. Now, just to set the scene very briefly, because we do have some real experts here, the carbon transition that we face, it requires some quite fundamental changes to society and the global economy. But there are typically a number of gaps in this. I'm quite a private sector enthusiast, and I see these gaps as ones that if we can construct the appropriate markets, will be filled. The first gap is, of course, implementation. Do people really mean what they say about meeting the goals? And the second gap is ambition. Have they looked far enough ahead to see where all of this is going to come from, that's going to get us, in theory, to something like net zero in 2050? Now, there are a number of techniques out there, and I think that financial centers have an important role to play as part of the solution. It's not just technology. We're dealing here with a pollutant, and what one would typically do with the pollutant is to tax it in some form or to charge for the disposal thereof. For those of you with memories, you'll recall that we used to talk about acid rain in the 1990s, and this was the sulfur dioxide, the nitrogen dioxide, and these were actually solved by markets. The United States Environmental Protection Agency, the EPA, instituted a crazy idea at the time for traded markets in 1992. At the time, their estimate was that over 10 years, they might be able to reduce SOx and NOx emissions by about 25%. In the event, those emissions decreased by 50% in just 4 years. And that's an important date because that was 1996. So the United States went into the Kyoto negotiations, which came out with COP3 in 1997, absolutely full of the idea that we've done a heck of a lot on one set of gases. Why not use the same approach for carbon? Well, that approach didn't work quite as well. It wasn't because the markets didn't work. It was actually because the governments issued too many permits. And the ETS in Europe, which was the forerunner of these, created, I might add, largely by the City of London Corporation here in London between 1998 and 2003, was launched in April 2005 and came crashing down in December 2007. But financial centers are definitely part of the solution. And what we're thrilled about is the growth in this market. In fact, the estimates here from Refinitiv are slightly contradicted by some estimates from Bloomberg. But whatever we're looking at something between about 865 billion and 900 billion in traded, in issuance of carbon market emissions trading certificates. And of course, the most exciting news on this front has been the accession of China, which opened up almost 2 years ago in July 2021 to enter the global trading system. But this leads to the things that we're going to be talking about today. The first is How do I trade amongst those systems? And where are these systems going? So we asked some respondents to our survey, the Global Green Finance Index, to assess the proportion of global emissions they thought would be covered. And the highest percentage, 60%, effectively considered that 30% of emissions will be within carbon pricing schemes by 2030. And that's up from approximately 22 or 23% today. So implying quite significant growth. And with something like 23% of global emissions covered by a credible ETS, perhaps it's time that we tighten up the screws on these markets and their emissions, increasing their coverage and encouraging other countries to join, because this is the thing that has led to the real reductions in emissions in Europe. Whilst a number of people are quite keen on things like ESG reporting, which may or well not have a place, definitely if it costs, companies will not be emitting. So I think we're going to be discussing quite a bit today on that. And just to give you a quick look at the program today, we are going to kick off with Liz Bosley, who's the CEO of Consilience Energy Advisory Group. She's going to be followed by Sui Ying, who's the Deputy Director General of the International Institute of Green Finance. Liz is dialing in from London. Sui Ying is dialing in from Beijing. And we seem to be having a small technical difficulty, but we're hoping that Adrian Rimmer, who's the Director of Sustainable Finance at LSEG, the London Stock Exchange Group, will be joining us shortly. So with no more ado, I'm really thrilled. I'm going to hand back control of the system to Mike Wardle, who's running things. And Liz Bosley, the floor is very much yours.
Good morning. I've been involved in the green space since I was about 10 years old, and I won a copy of Rachel Carson's Silent Spring as a school prize. So I've always been interested in the green space, anti-pollution, the CFCs, all that sort of thing. But I will come out with my hands up and confess now, I'm an oil trader. And I strongly believe in markets and the power of markets to change behavior.
Like it about you. Come on, carry on.
Right. I believe in the power of markets to change behavior. I got very much involved with the City of London Corporation in the preliminary UK emissions trading scheme and then the European emissions trading scheme, and got very much involved also in the COPs in the 2008 to 2012 period. I became somewhat disenchanted at the end of the Kyoto Protocol period, largely because as we came to the true-up period, the market was just flooded with emissions allowances, CERs and ARUs from Russia and China. And that made me feel very bad because I had a number of clients whom I had encouraged into CDM projects, and CDM projects involved choosing a greener option which was less profitable and making up the difference by being rewarded with allowances which were tradable. And one of the prerequisites of a clean development mechanism project was that you had to have the allowances to make the finance work. Well, of course, that's great. People got the allowances, they got the CERs, they got the ERUs, and they were almost valueless because there was too many of them. So that sort of made me feel that perhaps we needed to do things slightly differently. This whole emissions limitation and changing the global warming agenda is a bit like Sisyphus rolling his ball uphill, pushing it uphill. It seems we've got one thing right and then it rolls back down and we have to start all over again. We've got a few tools at our disposal here. Command and control. Just don't emit, it's illegal. Well, that's fine. In certain countries you can do that, but in democracies where the government has to get re-elected, saying you will not do this can often be quite unpopular and leads to an end of their tenure in government. There's tax, always a useful tool. If you go ahead and emit, we'll tax you. So it's a financial penalty rather than command and control where you run the risk of being thrown in jail. One of the problems with the tax solution is hypothecation. You raise tax money, what do you do with it? Well, if you invest it in wars, in social projects, then you don't necessarily get the benefit of using that money to mitigate climate change. We've got the baseline and credit schemes. You'll be rewarded with tradable credits if you choose the greener but less profitable solution of any two investment options. And that was very much a JI and a CDM model. And as I said earlier, the problem was we had too many of these allowances, these credits, so their price collapsed and the reward wasn't there. I like cap and trade. I'm a trader by nature, and I love the idea of cap and trade. And when the European Emissions Trading Scheme and the Kyoto Protocol was developing, cap and trade evolved very rapidly. The trade solutions, the contracts, the exchanges, they were a work of a moment and they were done. Of course, the caps weren't so easy. Caps had to be set by a political process. And again, far too many allowances were generated, so their price fell to the point where it's cheaper just to buy allowances rather than take action. So who says which of these solutions we rely on? Well, that's very much an international problem. Some countries will choose command and control, others tax, others cap and trade, but the majority of the schemes that are generating are private schemes, regional schemes, voluntary market schemes. And when you add all of those together and encourage more to develop, then you are more likely to get action than once a year sitting around a table with 195 other countries, all with their own agenda, trying to say, this is what's going to happen and we will sign up to it. That is doomed. Nobody has got the authority to enforce that. And in any event, I'm sure this will come as a surprise to you, but sometimes governments say they're going to do something and then don't do it. My goodness, yeah. So how do we measure whether countries are complying? Well, in the emissions space, there are only 4 countries that really matter: Russia, the USA, India, and China. If they cut their emissions in time with the zero emissions target, the problem is more or less solved. The rest of us can do what we can and should do what we can, but unless these countries join in and comply, then we're whistling in the dark. Now look at the data we've got here. This is from 1990, the sort of base year, through to 2020, where we've got the last UNFCCC data. As you can see, we don't have a lot of data that's more recent from China in the UNFCCC, and the Indian data is patchy. But look at the trajectory China was on, according to the last data, the trajectory that India was on. The USA is leveling out and looks like it's beginning to take some action. But Russia, which appears to be doing a good job, of course, is a whole other ball game, because the baseline was set in accordance with the pre-breakup of the USSR. So what appears to be a limitation of global emissions is actually just a record, records the fact that their economy collapsed after the USSR broke up and is still recovering. Now, this is a global problem and it needs a global solution, but there just isn't one. Each country's got its own agenda, and even within each country, there are conflicting interests. The UNFCCC does not have enforcement power. The Kyoto Protocol, if you did not comply in the first assessment period, you got a stronger target in the second commitment period. Well, la-di-da, if you haven't met it the first time, you ain't going to be encouraged to sign up to an even tougher target the second time around. Now, compare that with the International Maritime Organization. It said, as of 1st of January 2020, the sulfur content of bunker fuel is being cut from 3.5% to 0.5%. The industry shied up like a startled horse and said, oh, this cannot be done. This is going to cost too much. But it happened. They did it. And those who are not complying are fined. There's also the name and shame enforcement provision. If you don't, public opinion will be against you. Well, some countries don't really care about public opinion. And heaven forfend, if Donald Trump gets back in the White House, what, well, say no more. You can fill in the rest of that sentence yourself. In fact, our greatest contribution to the mitigation, stopping global warming effort was the financial crisis, where the economy collapsed, and the COVID epidemic. Let's not do that again. It worked, but as a solution, left a lot to be desired. In my opinion, each country, each region, various industry sectors should be doing their own thing and working towards cutting their own emissions. And although the Holy Grail is an international carbon price and we're all facing the same economic consequences, that's great, that's the Holy Grail. It's not going to work. The Kyoto Protocol showed us that when the GI ERUs flooded the market and brought the price down. We need more working, national, regional and voluntary schemes. The rules are clearer and less unpredictable. And there isn't suddenly going to be a political decision that lets in a flood of allowances from another country or another scheme because it's politically expedient to do so. That way lies failure. So little, small, building up, I think, is the best solution. And with good luck and a following wind, the big four will make a contribution. Now, I understand the politics of why certain countries did not become Annex 1 countries with emissions targets. When your population is starving, facing poverty, doesn't have electricity, then signing up to a global target to cut emissions is a bit of an insult, really. But why don't we just say, look, okay, if you're a non-Annex 1 country without a cap, let's give you a different cap. Let's give you a cap of your obligation to host as many projects as possible and host adaptation projects. And if you don't comply with that, then you have to submit allowances, which you will have to buy. Hosting projects is a whole different ball game from investing yourself to cut emissions. So the mitigation boat has more or less sailed, and it may well have sunk according to the latest IPCC report, which was terribly upbeat, but you can read between the lines. If the hope we had of cutting emissions and stopping global warming is really looking a bit dubious. So adaptation and how we invest in adaptation is becoming of crucial importance. And I think that's where a lot of the development of emission trading schemes should be focused on rewarding adaptation projects as well as mitigation projects. That's just this woman's opinion and the opinion of an oil trader to boot. So take it for what you will, and I will hand back now to Mr. Wardle. Mike.
Well, thank you very much indeed. And a fascinating overview really of where we've come from in terms of the development of carbon trading and pricing. I'm now going to move on and invite Ying, the Deputy Director General of the International Institute of Green Finance, to take over the session and to give a view from China and a sense of where we're coming from in Asia.
Thank you, Mike. Hello, everyone. My name is Ying. I'm the Vice Director General of International Institute of Green Finance, CUFE. IIGF is a research tank focusing on the research, on the green financing research. And I have work experience on climate change for 17 years. For the first 10 years, I mainly worked on CDM projects, and then for the recent 7 years, my research area is on climate finance and carbon market mechanisms, and also the green finance development in China and globally. Now I will share some situation in China on ETS and climate financing. First, I would like to introduce the dual carbon target in China. As we all know, that China has been actively employing ways to deal with climate change, and China announced the target that we call as 30-60 target, or dual carbon target in short, which means that China aims to hit peak emissions before 2030 and for carbon neutrality by 2060. Under the guidance of this target, China considers carbon market as an important policy instrument to help us achieve the target. As mentioned by Liz just now, carbon market is an important market-based tool for reducing greenhouse gas emissions and mitigating climate change. The 30-60 carbon target is meant for China to plan a low carbon development compared to the BAU scenario, and help change the development philosophy to achieve carbon neutrality in only 30 years. The carbon market, or ETS, is the same as cap and trade. Under this system, the government controls the total emission level and let the entity trade the allowances with other entities at a market price. So by giving carbon emission a price, a cost, and an enterprise will find its own way to balance emission and economic benefits without too much intervention from the government. Since 2017, Beijing, Tianjin, Shanghai, Chongqing, Hubei, Guangdong, Shenzhen, Fujian, and Sichuan in China have launched pilot carbon markets, providing valuable experience for China's national market development. In July 2021, China's national carbon market officially started trading covering key emitters of the power sector. Currently, the China national carbon market only covers one sector, that's power generation sector. For other sectors, if there are pilot carbon markets, then they will be traded in the pilot carbon markets. If there are not pilot carbon markets, then these industries are not involved in the carbon markets. For the national carbon market, it covers 2,162 enterprises and 4.5 billion tons of CO2, equivalent to around 45% of China's national carbon emissions. In 2022, the carbon markets cover around 23% of global greenhouse gas emissions. Among them, the Chinese national carbon market covers over 8% of the global emissions, which means over 1/3 of the greenhouse gas emissions covered by Chinese national market, which makes it the biggest carbon market in size. But if we talk about the trading volume, it's not China, it's definitely EU ETS. The carbon price of Chinese national carbon market is around 50 yuan per ton of CO2, which is equivalent to around 7.3 euros per ton. Compared to the EU ETS, it's still very low, but compared with South Korea and RGGI in USA, the price is generally the same as their prices. Different from the EU ETS that has a clear limit of the total greenhouse gas emissions, which we call as a hard cap for the carbon market. There is no such hard cap in China. We call a soft cap instead, which means the annual emissions covered by the carbon market is not fixed or limited, but it depends on the electricity actually generated. Since China's industries are still in developing, the need for electricity is also growing. The Chinese national markets is therefore based on this situation and using the benchmark method for allocation of allowances. The market mechanism encourages power generation with better efficiency. In China, carbon financial products are commercial activities based on carbon emissions trading that serve to reduce greenhouse gas emissions or increase the capacity of carbon sinks with carbon allowances, carbon credits, or other carbon emission rights as the medium or target of the financing activities. Since the carbon trade scheme is a market, the financial sector can participate more directly through the trading of carbon allowance derivatives. And the innovation of such carbon allowance-based financial instruments and products. Currently, there is no carbon futures traded in Chinese carbon market, which is potentially one of the reasons why the market lacks liquidity. In comparison, the European carbon market has developed carbon futures at the same time with carbon spot. Carbon futures have played an important role in the history of EU ETS. There was an oversupply in the EU carbon market in 2007, leading to a drop in the spot prices and contraction in trading volume. But carbon futures remained stable and contributed to the stability of the spot price. Now, carbon futures trading volume is hundreds of times bigger than carbon spots in EU ETS, and contributing the most of the liquidity of EU ETS. China in future could also consider bring in carbon allowance features to improve the mechanism of Chinese national carbon market. And then I will introduce some financial instruments that are using in China now. First is the carbon assets pledge loan, which is one kind of the carbon financing instrument, using carbon asset as the pledge to borrow money. Carbon allowances pledge loan is a loan issued by financial institutes to enable market players with pledge of carbon emission allowances. This business model effectively helps counter prices to lower the credit threshold and solve the difficulty of financing and the guarantee for energy saving and emission reduction enterprises. While lending, the relationship among banks, companies, and the registration agency is shown on the right figure. And currently, there are more than 27 provinces in China that are using such kind of financial instrument. Another carbon financing instrument is carbon bond, which is a kind of debt financing instruments that is related to carbon market. There have not been many carbon bonds in China now, but there are some examples. First, in Anhui Province, Anhui Energy Group issued a carbon allowance-linked debt financing instrument, which links its interest rate to the profits from trading the issuer's 7,000 tons of carbon allowances in the national carbon market. The second one is called the carbon asset pledge bond. Datang International Power has issued one typical such bond, which uses the issuer's 66 million yuan of carbon allowances as pledged assets to issue a bond for the market to buy and trade. The third is CCER linked debt financing instrument. But this one is just several years ago for the recent years, because the stop of CCER application in China, so there is no CCER, no new CCER projects. CGN Wind Power issued the first carbon bond of this kind in China, which links the bond rate to the issuer's CCER revenue. That's created a floating interest rate. All three financial instruments are carbon assets based or linked. And there is also carbon supporting instruments, and taking carbon insurance as an example. It includes carbon delivery insurance, carbon credit price insurance, and carbon asset financing guarantee. Shanghai offered the first carbon allowance pledge loan guarantee insurance in China. The business model is shown in this figure. When enterprises apply for carbon allowance pledge loans from banks, insurance companies can provide guarantees to help enterprises increase credit and provide risk protection for banks at the same time. Besides the carbon market, there is also climate investment and financing work going on in China. And here I will introduce the climate investment and financing pilots construction process in China. In December 2021, the ME and 8 other departments issued the notice on pilot work of climate investment and financing, deciding to carry out a pilot plan of climate investment and financing. According to the work plan, the local governments can work on pilot application and construction. In August 2022, the MEE released a list of climate investment and financing pilots, approved 23 places to become pilots, including 12 cities, 4 districts, and 7 new national areas. The pilots are required to develop their own pilot development plans that fit their specific situations and needs. The pilot development plans are expected to guide the pilot places to take local context into consideration, establish a cross-departmental coordination mechanism, clarify the division of rights and responsibilities, and specify timetables and roadmaps of the pilot development. Recently, the MEE issued the standard for selecting climate finance projects and making project library. According to the standard, the mitigation projects are classified into 5 kinds, like low carbon industries, low carbon energy, CCUS, non-energy greenhouse gas emissions, and carbon sinks. Also, the standards calls for the climate adaptation projects. Also, the pilots are required to curb the too high projects, which means projects with high energy consumption or high emissions. For example, the Shandong province starts from the source control of the too high industries and strictly control the carbon emission of new projects to ensure that the total carbon emission of the too high projects will only be replaced by emission reduction from elsewhere, such as shutting down enterprises or phase out outdated production capacity. So the pilots are required to develop low carbon projects and reduce high carbon projects at the same time. And that's a process, and this process should be assisted by use of climate finance. There are a lot of innovative practices in climate finance pilots. Each pilot is making the most of its own advantages to promote climate financing and low carbon development. Here I take Qingdao, Wuhan, and Lishui as three typical examples. Qingdao is building a local climate investment and financing project library. The standard for selecting project is in compiling. Now 20 projects with significant climate benefits are selected from more than 100 candidate projects. The Qingdao government is also building a cooperation among the government, the enterprises, and the financial institutions to better support the development of climate finance. And Wuhan undertakes the registration responsibilities of the national carbon market. So it wishes to bring together the financial resources attracted by the national and pilot carbon markets institutions, and to build a core hub of the national carbon market and a national carbon financial center to attract financial resources from not only Hubei province, but also other areas in China. Basically, Wuhan wants to become the carbon financing center in China. And Lishui is different from most of other climate finance pilots. The pilots are usually cities with advanced industries and a big scale of carbon emissions. But the carbon emissions of Lishui is always at a very low level, even with a negative level. In 2019, the net greenhouse gas emissions of Lishui are about minus 100 million tons. So Lishui is now focusing on realizing the value of the eco-products like carbon sinks. It has published a series of policies like the 3-year action plan for carbon sink eco-products value realization to use the negative carbon emissions to create real values and benefits the local economy. So that's all of my sharing. Thank you very much.
I was thanking Ying for a fascinating set of insights into the development of markets in China and some of the pilot work which is going on. Really very interesting indeed. I'd like now to invite Adrian Rimmer to take the floor, Director of Sustainable Finance at London LSEG, London Stock Exchange Group. And Adrian, the floor is yours. I think you also have some slides to share with us.
Wonderful. So I will talk mostly about the voluntary carbon markets, but there's a bit of an introduction and context to that first. In my role at the London Stock Exchange Group, I work within our sustainable finance team, which is really the kind of commercially focused part of it, so rather than the corporate centre. And we work with the various different parts of the group to help them define and implement a sustainable finance strategy, which really is supportive of a very broad commitment on behalf of LSEG to support and drive the low carbon transition. I've been in the sustainable finance space for the last 17-ish years. Initially on the investment banking side, I sat at the environmental markets desk at a Dutch bank called ABN AMRO way back in 2005-06. And that was one of the first investment banking kind of initiatives in that space. Between there and joining the stock exchange, I then ran an organization called Gold Standard, which is a certification body in the voluntary carbon markets. So we've been doing some voluntary offsetting through the compliance markets at ABN AMRO, then moving much more into the sort of pure play space. My work at ABN AMRO, sorry, at London Stock Exchange Group sits across a range of areas, but in the last couple of years, particularly, we've had a big focus on carbon markets. And why is that? Partly because with the expansion of the group after we acquired Refinitiv, we actually have carbon-based activities. We have a research team that's been established for almost 20 years called originally called Point Carbon, now Refinitiv Carbon Research. They were doing some of the original research on the clean development mechanisms, the UN mechanisms, and have since then been doing focus their attention on the compliance markets. They've now added voluntary markets coverage as well to complement the work that we're doing more broadly. In other areas, we really looked at this market and said, oh, where do we fit into this? I think there's a complementarity between the work we're doing on climate transition for our corporate listed clients within the London Stock Exchange PLC, so the equity trading venue, and also the broader work we're doing across the group. We have spent a lot of time focusing on helping corporates understand climate disclosure, understand what best practice looks like, where regulation's going, and providing them with tools to help themselves to benchmark themselves. We work with, on the other side, the investor community through FTSE Russell and through Refinitiv, building data platforms and creating indexes based on those that allow them to orient their portfolios to those companies that are most progressive in supporting the climate transition and transitioning their own businesses to mitigate climate risk. So it makes sense that we would look beyond that into the carbon markets. And when we approached that, we really wanted to look at the dynamics of how that was working in practice. So the voluntary market is a global market. It's very small, but it actually is one of the tools that is recognised that we can be used to actually deploy capital into around the world, but particularly to developing countries in the global south. And it's been very successful in doing that. It links with our offering. We work with countries around the world, particularly lately on green and sustainable sovereign bonds, and also with green companies that are being developed there. That is companies that are actually their core business is a green product or service, often climate oriented. So again, this sort of complements the wider offering we have and the work that we do with companies. But let's come to the voluntary carbon market specifically. The market is small. It's about 2 billion in traded value last year, more or less the same the year before that, but has doubled year on year in the previous years, and we'd expect to see it increase again. So it's growing rapidly. Projections are, depending whose research you read, somewhere between $30 and $50 billion of traded value by 2030. So this is a market and a new asset class that's growing a lot, and it's becoming more entwined with government policies. So as Liz said, and I would tend to agree, I think the success comes when countries or at least regions design schemes that are relevant to them, that actually drive capital to where it's needed, that reflect their specific situation, i.e. are they a nation with a lot of forest cover or not? What is the nature of their industry and so forth? And if you design a scheme that is reflective of that and can support the decarbonisation or the growth of industries that support the transition, then that makes a lot of sense. And the voluntary market is really a tool for doing that. Increasingly, we're seeing offset or carbon credit driven markets being created around the world and aligned with policies too. So in South Africa, you have a carbon tax where you can use carbon credits from that country instead of paying the tax. And that's to drive investment into carbon projects, yielding those credits in South Africa and having a transformational difference to communities in terms of energy access, etc. So that being the case, I think the growth that will take place will not just be voluntary action from corporates, but it will be increasingly policy driven. The Indian government recently announced that it was going to sort of effectively ring fence Indian generated carbon credits and do so in order to create a demand from Indian corporates. So actually create policies that will drive them to offset their emissions and use Indian based credits to do so. So we can see that that's an important part of it. And the other key thing I have noticed is governments are now waking up to the fact that carbon is a national asset, either in terms of carbon stocks or the carbon that can be generated. Voluntary carbon markets have grown and been successful in terms of innovation in this area because they've been largely sort of left to their own devices without much government intervention after the CDM effectively stopped being used in any meaningful way. And that allowed a lot of innovation, but what it has meant is that the projects that take place within countries are delivered, but most of the revenues that are generated in terms of profits from the carbon credits that are yielded is effectively moves back to developing countries, because it's often the kind of Western European, US countries that are developing the projects. They're doing that through the auspices of standards bodies that are based again in those countries, in the US in the case of Vera, in Switzerland in the case of Gold Standard. And therefore the assets that are created are then removed effectively from the country. So countries are waking up to the fact that they're missing out on a large part of the financial benefit of those projects taking place, even if there's benefits being delivered on the ground. And they want to capture that. So we're starting to see moves where policies are created that will align carbon markets with their UN commitments, so their nationally determined contributions. And that will require, therefore, any credits generated to have what's called a corresponding adjustment, which is where the carbon credit is, if it's going to be sold elsewhere, is netted off against that NDC. And that's really important in terms of the claims that are being made and the sort of broader carbon accounting frameworks that exist. Now, if they're doing that, they want something in return, and that's likely to mean that they want to put in place a concession, or they want to tax the revenues, or they want to receive a share of the proceeds in some other way. And I think that's a good thing, because that really will mean that the capacity locally is built, and that an appropriate share of revenues from these activities are retained within the country and help it both build further projects, but also adapt, as Liz mentioned, which is important. I think the thing to mention around carbon markets is they have a huge potential for supporting adaptation, particularly projects like mangroves, where mangrove planting on coastlines is a huge benefit in terms of adaptation, as well as the carbon that it's sequestering during its lifetime. So there are ways in which you can combine carbon finance through the carbon markets without necessarily a pure focus on adaptation. But again, I'd agree that that's helpful to have also. I think for the most part, we can assume people on this call understand what carbon markets are. So I won't dwell on this, but essentially, I think the key thing is it's a financing tool. And at its core, it's a mechanism for putting money on the ground, and it is based upon payments for outcomes. I think that's a really important and distinctive part of carbon markets, where they're used in terms of carbon credits, because you have to deliver what you say you're going to deliver. You have to measure it and have that independently verified. And then you're paid effectively, your asset is given to you once that outcome has taken place. We always talk in tons of carbon avoided, so that's the sort of common unit that's used. Let's say it's carbon avoided, reduced to remove, it's always talked in tons. And it can take place worldwide, provided that the activities that it's being generated from wouldn't have taken place otherwise. And that's a mechanism called additionality. And there are various different ways you can determine additionality. And I think that's quite an interesting area where you start getting quite a bit of debate, particularly as you start crediting activities within Western countries where pre-Paris that wasn't possible. Moving on, really just looking at the life cycle here, I think what I want to show here is just the complexity of VCM projects, but also the rigor that can take place if you use the main standards bodies. And that's being enhanced with ratings agencies that are effectively taking a sort of third look beyond the independent third-party review of the process, which I think is incredibly helpful. But essentially, you come up with an idea, you select your standard and the methodology, the accounting methodology, and the workflow that is required to deliver that activity. You undertake that, and all of that data is tracked through the registries of the standards bodies, a database that records that workflow, and into which credits are issued. So you have regular third-party review points, and then once those credits are issued, they can be transacted, and they can be transacted multiple times before they are eventually retired. Retirement is when a claim is made against the emission reduction or removal that's taken place, and those claims are audited also. And so it's important that right throughout that there is a clear flow of verification that what is being claimed is being delivered. And you have a huge amount of NGO scrutiny on top of that. So Gold Standard was created by the NGO community, We spent a lot of time engaging with those groups as well as governments to ensure they were comfortable with new methodologies. And we also had grievance mechanisms that they could raise issues if they felt that there was a challenge or a problem, either on the ground specifically or with an approach generally. So what was the goal of engaging with this? So we looked at this market and we said, look, there are a number of organizations and indeed other exchanges creating trading venues for secondary credits. We don't think that's the main challenge with the growth of the market. It helps certainly to have a liquid trading venue, but this is not a liquid market yet. And so we decided our focus was better placed on the supply side, actually getting more capital into projects on the ground and creating a way that the public markets could be used to deploy that capital, because they're very good at doing that at scale. We have over 30 green funds on our markets, green infrastructure, renewables particularly, but also energy efficiency, energy storage. And they're very effective tools. The sort of fund structure that's used for that gives investors in public equities effectively access to investments in illiquid underlying assets. So, wind farms and so forth. We decided that was analogous to the way that the voluntary carbon market works, because these projects are long-term by their nature. They are illiquid in terms of the way that they're designed, and often they're challenging to sell because ownership and licenses, particularly in areas like forests and land use, is challenging. So to invest directly in a project is to take on a huge amount of risk, not just the delivery risk of the project, but the political risk of the country, and to have an asset that is illiquid. That leaves you with, as a buyer wanting the carbon credits with just the secondary market to play with. That's quite volatile in terms of pricing. It's opaque in terms of where the credit availability is. And you can pay anything between sort of $2 and $200 per ton, even more. And there isn't really a lot of rhyme or reason behind that. Credits that have that are using the main standards, obviously we trade at a higher price. Credits that have greater transparency and verification around co-benefits, likewise. But fundamentally, it's really still a matter of how good is the person selling the credit at getting a high price from the buyer. And we wanted to change that dynamic and really make the market work better. So our approach really was to say, how do you increase the flow of financing in, and how do we also provide new routes to market access for investors and corporates that are seeking exposure to carbon credits, either the credits themselves or the revenues from their sale. And what we've done is really put in place a mechanism by which, by adding a set of VCM-specific rules to our listing rules, we've created a mechanism for funds and indeed operating companies, if people choose that structure, that are going to be investing into activities that will yield carbon credits, to undertake a set of commitments to additional disclosure, and also to work within a set of guardrails that will help to make investors' choices clearer, simpler, and give them more information. So the way that it works, broadly speaking, is that to achieve the designation, you need to be using one of the main standards currently defined by the CROA, which is an industry body, but will be migrating once it exists to the ICVCM, the Integrity Committee for the Voluntary Carbon Market, when they've produced a sort of final piece of work, and assuming the market chooses to adopt that, which I think is highly likely. That means that you're using mainstream standards, but you still have a lot of choice as a fund manager or investor. The funds then commit to additional disclosures up front around the capabilities, the risks that they're undertaking, the way that they're mitigating those risks, and other issues like the expected yield over time, risks of that yield, things like the claims that are being made around sustainable development goals, how they're going to be backed up. So you can't just sort of stick a pretty badge on, but you actually need to explain and demonstrate against a baseline how you're delivering those, as well as the carbon reductions. Because we know that adds value to the activity. There's an ongoing requirement to disclose on an annual basis, so the progress of the investments that are being made. And then indeed in the disposal of those assets, we require clarity over where they've been disposed. So have they been sold, have they been issued to investors, or some combination? And when I highlight the issuing to investors piece, I think this is a key part of that. By receiving a VCM designation, funds can choose if they wish to offer investors a dividend of carbon in specie, so instead of or as well as a financial dividend, depending on the strategy of the fund. Now that's incredibly important because that allows them to access a new source of capital. It allows them to attract corporate investors, which typically wouldn't invest in a fund on our markets, and it allows them to lock in some of the buy side effectively to their fund. So again, it de-risks the fund for those who are seeking a financial return. For the corporates or those seeking access to carbon credits and to want to take ownership of them, it means that they can invest in a fund, so buy equity shares in a fund or a company. They have much greater transparency than they would have if they're investing directly into a project. That's mandated through the addition to the listing rules, and because it's laid on top of our listing rules, it's subject to the market abuse regime. Now, what does that mean? It means there are criminal sanctions for making sure that information is accurate and timely. And we think that will really drive a flight to quality. It means that those who are seeking to list these vehicles will, by definition, need to be doing it in the highest quality way and be very comfortable with the information they're providing and the delivery capabilities they have. And that in turn gives investors confidence and access to those higher quality credits on the basis of that work. But for the corporate, it also means that they can invest in a vehicle that will yield them carbon credits over time. They'll have an idea, not a guarantee, but an idea of what that expected yield should be. And they can align their investments to deliver some or all of what their requirements will be over time. But it gives them a hedge against changing needs. If they're more successful at decarbonising and they need fewer credits, they can sell out of that fund. Because it's traded on a daily basis, it's an equity share. Or they can buy more if they find that the reverse is true. They can diversify, so they can hold multiple funds. And if they find in 5 years' time that they're actually subject to an entirely new sort of regulation that requires them to make a commitment to carbon credits that are not where the credits yielded from their fund they're invested into is not eligible, they can sell out of that fund. So it gives them a hedge against future regulatory changes, and we expect there to be a lot of fluidity in that over time. So we think that this tool solves for a number of challenges. It solves for capital at scale into projects. It solves for quality approach, bringing the investment activity, if not the assets underlying, under the regulatory regime. And it solves for market access for those who need a long-term stream of credits. Corporates that are making commitments now on top of their science-based targets are making a multi-decade commitment to offsetting their unavoidable emissions. That's a commodity exposure. Of course, they're going to want to, certainly for the time being, really think about the types of project they want to invest in, whether they prefer to invest in forestry or technology-based projects or high impact, social impact projects like cook stoves. And they can do that through this approach, but it really gives them a lot more flexibility in how they do that. And it enables them, importantly, to demonstrate to their investors and stakeholders in turn that their strategy is both affordable and achievable. We're starting to see banks now look at some of the commitments made in terms of net zero commitments and offsetting as a potential credit risk. If the market price goes from an average of, I guess, about $15, $20 right now to $70, $80, that could make it very unaffordable. It's a material change over that time. And the supply may well be restricted, in which case, can you even access the credits you committed to delivering? So we think that this really helps the market in all of those different ways. I've touched on those benefits, and we can I'll distribute the slides afterwards, so very much happy to do that. I guess something that's worth highlighting here is we're seeing that with the commitments being made over the long term, corporate treasuries are now starting to get involved. It's stopping being purely a marketing budget or a sustainability budget, and now being something that the finance departments are managing. They need a way to do that effectively and to be able to demonstrate they're doing that in a cost-effective manner. So this enables them to work in a way that they're much more traditionally comfortable with in terms of managing exposure. I think this is this is the first time we've seen a public markets vehicle for investment in carbon with sufficient safeguards that will help support the market. So I'm conscious that the session as a whole has run on. I would happily take questions around how we build upon that and any questions about how this works in practice. We're looking more broadly, as Elle said, at the carbon markets. So we're starting to think about other areas we can get involved in. I'm particularly interested right now in looking at how we support price formation in the secondary market, because that is really a big challenge. And we have some interesting ideas around that. And so as a sort of financial markets infrastructure group, generally that's the approach we're taking, is we're not a commodity trading venue. We do that a little bit in some areas, but really we are, what we're very good at is providing data and infrastructure that enables markets to work and enables investors to meet those who want to deploy capital into certain areas. So with that, I will close my presentation and have to take questions.
Thank you very much, Adrian. It's a really great oversight of the voluntary carbon market and how it's being used in the economy at the moment. So thank you for that.
Thank you.
We do now have some time for questions and comments. We'd invite you to use the chat mechanism. It's on your dashboard. If you just put a chat to everyone, then we'll all see the questions as they come in. And comments as well. And panelists and Michael, please do indicate if you'd like to join in the discussion. But Sean Turnbull has asked a reasonably direct question on how effective the legal actions taken by Client Earth in reducing carbon emissions. Should they sue governments for having money that creates market failure that continues to drive us on a highway to climate hell with 8 billion feet still on the accelerator? Who wants to take on the question of Client Earth and the role of activism, I guess, in continuing to get pressure on the system? Michael, do you have any thoughts on this? You're on mute at the moment.
Well, afraid not, but Liz, I think it's about to kick in. Liz, over to you.
Yes. Yeah, I was a member of Greenpeace for a very, very long time, even while I started off in the oil industry. And I believe there is a role for activism in changing governments' minds. I mean, one of the things I listed was, the court of public opinion, and that is seen most strongly in people like Greta Thunberg and young people. If you talk to any school child at the moment, they know about global warming. They know about the dangers of climate change. And I would say bring it on. The legal action may or may not be successful, doesn't matter. It raises the public profile, it gets people thinking about it. And frankly, the more the better. I mean, I live right in the centre of London, at one end of Westminster Bridge, the business end, not the political end. I have tried to do something very simple, get some solar panels on my roof. I can't get permission to do that because it interferes with other local residents who will have to look at my solar panels. I cannot recycle. I live in a building where there is one recycling bin amongst 30 flats. And if you look at the recycling bin, the cleaners just dump it down into the trash once it's full. The greater the public awareness, the greater the actions that are taken, the better. I'm not an exponent of violence. I'm not an exponent of gluing yourself to things. I think that's bad publicity. But the more we talk about this, it can only help.
Thank you very much, Liz. We've got some comments in, Adrian, particularly the question directly to you, just about, or two questions really to you. First of all, just whether you wanted to expand on your interesting ideas on the formation of the secondary markets. But second, just saying there are potential VCM projects looking for bilateral off-takers under approved methodologies, and how does LSE help marry the two? Or do we just need to use a broker?
Thanks. Yes, this is exactly part of the challenge we're looking to solve for. Right now, the various different market participants don't know each other, and they find it quite hard to transact with each other, by which I mean large corporates, for the most part, don't have the time or capacity to find out who every single project developer is, what they're doing, how good they are, and then to enter into a financial agreement with them, particularly because many of those sort of project developer companies are quite small. So for a large corporate, that's always a challenge. By entering into a long-term agreement, which is what the project developer wants, and quite rightly so, the corporate is incurring a huge amount of risk for delivery, and sort of concentrating that risk in a few projects. So if there's a reputational issue, they are the ones that take the beating rather than the project developer. So what we are solving for here, so as a result of that, that's why the intermediary market has become the most profitable piece of the carbon market. Brokers make most of the money in this market. Whether they're brokers or broker advisors, it doesn't really matter. And that's fine because they're providing a service, but the reality is we want more money going onto the ground. So this structure allows investors, fund managers or companies to list on the market, to receive money in return for equity shares in their fund, and to deploy that against a strategy where they can then return the carbon credits that are being yielded to their shareholders. So you will, and we will. The first fund that received the designation is a combination of that financial investors for a financial return and those who are seeking the carbon credits. But what it means is that you can join those two parties together in a way that mitigates the risk of the investor, the corporate looking to buy the carbon credits and invest in the projects and support them, by giving them liquidity on a daily basis, by giving them, and those shares are traded, so that means they go to somebody else. And to mitigate the risk of those credits not being useful to them in the future, whilst giving the project developer money up front. And that's something that, again, has been a real challenge in this market. So yes, it does that exactly. To the point on, did I see the point on the Global South? Yes, I'll just cover that off there. The carbon markets, historically, that's where the capital's been deployed. And they're great tools for that because it's very hard to get, there are a lot of challenges politically and in terms of getting money to remote places in challenging countries. In the case of the carbon markets, it's result-based. So you don't get issued with the carbon credits until you've demonstrated you've done the thing you set out to do, that whatever you put on the ground or maintained on the ground is there. And that it has had the effect that you said it has in terms of reducing or removing carbon. So it's incredibly useful in developing countries for doing things and getting outcomes to people. And we would love to see developing country focused funds. We're having conversations with many of them at the moment that are listing on our markets. We think it's a really useful tool for that.
Thank you very much, Adrian, for picking up that issue of the Global South. So if I could turn to Ying and just ask on behalf of Michael Nelly, how are foreign companies participating, if at all, in the Chinese ETS markets? And is there any cross-trading going on with, say, the EU ETS, or is that still in development?
Okay. The foreign companies can only join some of the pilot market in China. For the national carbon market, it is not allowed for the not only the foreign companies, for all financial institutions in China, they cannot participate in the trading of national carbon market as well, because for the national carbon market in China, for opening an account, it can only be the companies which are controlled by the market. So for all other institutions, they cannot open account in the market. But for some pilots carbon market, such as Shenzhen, Guangdong, and Hubei, I think they can. The foreign companies can participant in the trading in these pilot markets. As for the cross trading, in China, there's no cross trading with any other country. It's just the national carbon market and the pilot markets. And the pilot market, for the pilot market, it can only be traded within that region. For example, if it's Beijing market, it can only be traded in Beijing and not cross traded with other provinces. But you can use CCER, like the China CER from, for some pilots, you can use some CCERs from other provinces, but I mainly encourage to use CCERs from their own region. So for the cross trading, it is not happening now. Okay, that's my answer.
Thank you very much. And I think one of the things we're interested in is whether cross trading between markets does become more of a reality over time. And I just wonder whether Liz or Adrian have any comments on how they see that future in terms of linking up markets and making those connections.
You want me to answer this?
No, I was going to ask Adrian and Liz if they have thoughts, but also Ying, yes, if you have thoughts about the future of markets, we'd be delighted. So perhaps Adrian first, Liz, and then Ying.
Okay.
Thanks. So yeah, I think it's going to be really important because as these markets develop, and I do think they will be regional as they are now in terms of compliance markets and sort of policies that support climate action, you're going to have companies that have exposure in multiple markets. So they're going to need a mechanism for addressing where they're long or short. I've always thought that would be financial linkage. It's really quite hard to link emissions trading schemes. It took 7 years to link the EU ETS to the Swiss ETS, even though they were more or less identical. So you know, to do it that way sort of undermines the principle that I think Liz mentioned, and I agree with, which is that they're best designed with the local outcomes needed in mind. So it will be financial linkages that allow for that. You know, I mean, even something like our fund structure could be used where you have a diverse portfolio of activities where you've got offsets from different schemes that are eligible in different areas. But I think you're going to have financial instruments that really start to allow for that. And then I think some common sense of what the high benchmark is for carbon markets. Again, I'm talking sort of offset really rather than permit driven. Just because permits can be issued by governments and therefore they can sort of, you know, there's potential for them to be gaming the system. But in an offset driven world or carbon credit driven world, you can you could have a kind of common understanding of what the high water mark is and a reference point for where other schemes sit on that basis. So you could actually end up with sort of discounted tons of carbon, if you like, that reflect a ton of carbon in a particular scheme, but at a kind of global level of carbon may be considered to be 0.7 or 0.9. So there are some interesting ways that you could do that. The World Bank's done some work with its carbon markets task force as well in that area. Liz.
The way I've looked at this in other commodities is that any price is made up of 3 components. There's a kind of benchmark, the international standard price, the commodity that is recognized by everyone. And then there's a sort of timing component. When is it going to be delivered? When are these allowances going to arise? And finally, what is the quality of those allowances? Once we have an established international benchmark that everyone recognizes, even if we don't have fungibility, even if we don't link the schemes, I will say this is a successful market when you see a voluntary carbon allowance trading at a differential to the benchmark. Then I'll know that we're making progress. I don't think we have that international benchmark yet. Maybe it's the EU ETS is going to be one such benchmark. But if you're doing a project in Tuvalu and it's producing credits, it would be very interesting to see them trading as a differential to the benchmark EU ETS or some other successful scheme, which may have a volatile price, but is a price that can be relied upon not to be suddenly changed overnight by a political change of mind. I think there's another aspect to this, which is one of the questions that one of the delegates asked about verification. I think what's really lacking is good quality training of verifiers. I mean, no matter what we say, what we do, what really matters is boots on the ground saying, what have they done? Have they done what they claimed? And what are the actual allowances saved? And there isn't a sort of standardized training for that. If I can draw an analogy with the oil industry, the closest we have to that is the independent inspector that goes in to inspect every cargo at loading and discharge. What happened during the loading? What's the quality of the product? And there is a saying in relation to certain of these independent inspectors that they're the best that money can buy. And that means that they are susceptible to bribery and corruption. And everyone knows who they are, and the reputable companies don't use them. This needs to develop in the emissions verification space. We need good training. We need companies whom you can say, well, if they go in and verify it, I can trust what they say as accurate, not that the guy on the ground's received a brown envelope from someone. Training is absolutely key to the developing of markets. And as I said, once we see a benchmark that other schemes can trade in relation to, then we're going to see a successful ETS market.
Thank you very much. And Ying, some thoughts about the future of connectedness and trading?
Oh,
Yeah.
yes. I mean, trading can actually be
Sorry.
very effective. Sorry, was that not aimed at me?
Sorry, Liz, I was asking Ying.
Oh, sorry, I'll shut up. Thank you.
Okay. Just I think the Article 6 of Paris Agreement give the chance for cross trading of the carbon emissions. But there are many problems, like there may be different policy frameworks, different situations of different countries and different NDCs. Making because we did some research on market link, even in the Asian area, but it's still very difficult because there are some realistic problems. And maybe for just for allowance, maybe for like CER, like the come offsite, the credit maybe is easier because it's if different like in China, it is in discussion whether some like with ER's emission reduction, some carbon offsets from other countries can be used in China, and China's offset can be used in other countries, things like this. But still, there is the problem that a different country has its own NDC. Then there should be no double counting. And then if used, if the emission reductions are used in other countries, then how this country can achieve its own NDC. So there are still many problems to be solved for cross trading of different markets. Okay, that's my comments. Thank you.
Well, thank you very much. And just wonder, Michael Manelli, whether you have any final thoughts before we bring the session to a close.
Well, I will bring it to a close if I might. Michael, first, I'd like to thank all of the presenters for the preparation that they've made, and thanks to the audience as well. I think there's some fascinating things that are going to be emerging here. We're seeing the carbon markets are finally, and I think Liz has expressed some frustration at how slowly, but nevertheless, they are motoring now, and we're going to be looking at a whole variety of areas. And as Adrian was chatting, don't ignore the voluntary carbon markets. They will grow, and then we haven't really had any time to talk about offsets either. So there's a lot happening out there, and I think that we globally need to be alert to it, and I appreciate people coming together at an early stage to discuss it. So thank you very much. Back to you, Mike.
Thank you, Michael. Well, we have reached the end of time. I know we haven't got to all of the questions, a couple unanswered, but we'll try to make sure we make connections at future events. For those of you in London, just on screen, just highlighting an event we are holding on the 23rd of May, that's just in advance of the City London Net Zero Summit, to look at the financial architecture reform, I guess, catalysing green development pact. So if you're around in London on Tuesday, the 23rd of May in the afternoon, please do come along, and the link is here. As speakers have said, we'll be trying to gather the slides from the event today, and we'll be posting those that we have on the event page, and indeed a recording of the session will go up on the event page in due course, so that you can watch again, or you can invite your friends to take a look. So just by way of thanks again, to echo Michael's comments at the beginning, to thank the sponsors of the FS Club for allowing us to put on these events. A really big thank you to our speakers, Liz Bosley, Jay Ying and Adrian Rimmer today. We've had a really fascinating set of insights, and I hope we'll be able to continue this conversation as we go forward. But for now, thank you for your attendance. Thank you to our speakers, and we look forward to seeing you again. Thank you very much.